Good afternoon, folks. I'm Dave Burrows, Chief Investment Officer and CEO here at Barometer Capital Management. I want to thank everybody for joining today. We're going to try and take a quick top-down view of what's going on in the world and how that squares up with what we're doing in our portfolios. I know a lot of folks have been away over the past week. I was away for a few days. And I know Diana did the webcast last week and did a great job. I've got James Callahan with me today. James is one of our most important portfolio managers. He's focused on U.S. equities and has taken a lot of responsibility in the tech sector for us and has done a wonderful job. So he's going to come on a little bit. We're going to talk a little bit about some of the developments there. Just to kick off from the top as usual, if you'd like to ask a question, please don't hesitate to tap a question into the chat. And we'll do our best to answer them as we get close to the end. And of course, if you're too shy, don't hesitate to send us an email or give us a call. We're happy to go through stuff with you. So just from the top-down view, we continue to think we're in a bull market in stocks that started in 2013. We think it's probably 2/3 of the way through what will ultimately be sort of 15 or 17 years. We'll see. We've got to continue to evaluate that. But as it stands right now, since 2013, the S&P has been working its way higher. It was, of course, the first market to come out of a funk and has been a leader all the way along. We've had a number of cyclical bear markets along the way. The most recent one lasted 26 months, and we came out of that in the early part of January this year. The low was in October of 22. And on this webcast, we've talked about it sort of on a weekly basis. Our view has always been that it tends to be that secular or multi-year bull markets tend to hold above a rising 200-week moving average, and that certainly has been the case all the way since 2013, despite some pretty, hair-raising ups and downs along the way. If we look at all the years where the S&P was positive in November, December, January, and February, we put this chart up a couple of months ago. It tended to be that the month of March was positive, with only a couple of exceptions. Certainly, the full year calendar return was always positive, an average of 21%. The final 10 months of the year up just about 15%. We seem to be continuing along that track. I recognize that in an election year, it tends to be that from the end of February through the middle of March, you might get a little bit of bumpiness. Really, this is only 2-3%. When we look at what's actually happening, in the last 15 trading days, the market's basically marked its way sideways. So it's been a pretty steady series of higher lows and higher highs for the market. This is the October low this year. That's the most recent time our breadth indicators turned positive. And of course, we've been on a run ever since. One of the things we watch is the moving averages themselves. This is the 200-day moving average. This is the 150-day moving average. Clearly long-term uptrends. We're trading above the rising 50-day moving average, rising 21-day moving average, and the rising 8-day. The first two things we would watch for outside of changes in our breadth models would be to see this index or the NASDAQ 100 break below the 8 and the 21-day or even challenge the 50-day, but we don't at this point see any sign of that. So what's in motion tends to stay in motion, especially when you've gone 26 months without making a high and finally do. It has been historically the case that the market has room to run after you make a new high. And I know that there's lots of people not positioned for that. We are. Our view is that lots of investors are going to have to reposition from their very defensive stances. And part of that's going to have to happen in Canada. Now, very tough year last year in Canada. 2023 had tons of ups and downs, not a lot of trending. But ultimately, like in the US, we saw a low in October, and the market's been trending ever since. We got above all of this resistance. And when we look at the bigger picture view, like in the US, when you go multiple years without making a new high and then start making new highs, this is what we're having happen in Canada. So the market broke out in 2021, had a pullback with the US market in 22 and consolidated through 23, but looks to have resumed a new long-term bull market. Now, sadly, these things tend to happen without everybody on board. And when we look at what foreigners were doing from outside of Canada, they were big sellers of stocks. In fact, it was the biggest year of selling of stocks going back to the 1980s, just in time for things to turn and for people to be under position. That probably has something to do with the fact that a lot of Canadian sectors are more economically sensitive. There was real concern that the Canadian economy could run into some headwinds. So far, it's been remarkably resilient, and certainly some of the sectors are more sellers into the global market than they are into the domestic market. However, because of that, the TSX earnings multiples doing at 14 times, the S&P at a little over 20 times, again, partly to do with the difference in the makeup of the sector weights. But that's a pretty big differential between the two. Sorry, this is global stocks versus US stocks. So Canada, a lot like global stocks. But that big discount is significant, and it's something that we watch for, because often toward the end of a long bear market, things get pretty inexpensive and under-owned. And we know that after a very long time, Japan has been having a great move. You know, in the last 12 months, Japan is up 47%. So this has been the leading market in the world, in a market that very few people own. Outside of, well, we own it, and Warren Buffett's been a buyer over the course of the year. Japanese banks are one of the big reasons. Banking sector is very large. The trading companies are important. That's what Warren Buffett's been a buyer of. And certainly, you know, there's a lot of stocks trading above their 50-day and 200-day moving average. We think that that looks pretty good. India has been behaving exceptionally well, though pulled back a little bit over the course of the last month. I don't think that that's a big deal. We took our position down slightly. But that being said, again, it looks like it's come out of a multi-year bear market. In Europe, you know, Europe, in fact, over the last 12 months, Europe has outperformed the equally weighted S&P, up just about 27%. So what I want to point out here is that when one stock in a sector does well, that's great. When a few more stocks in the sector do well, that's better. It means there's a trend taking place in that neighborhood. When one market does well, like the US, that's great. When a few more start doing well, it means that it's actual buying in the equity asset class. And that's what I want to point out. We're seeing a broadening of participation in global markets. It means increased ability to diversify. And it means probably that there are legs to the strength of this market. Mexico looks similar. Moving to fixed income, you know, generational low in interest rates in 2020 after falling from 1981. It's been pretty sticky, the rise in rates. This is 10-year yields. We've made higher highs and higher lows now since early 2020. And recently, again, long-term yields have been moving higher. In fact, last week was the largest one-week move in 10-year Treasury yields since last October. So that sort of flies in the face of the fact that a lot of investors have said, boy, 4% yields sound pretty good to me. You know, I'm going to be a buyer. The 12-month return for the aggregate bond index is 1%, not much off the lows. And we can see that in the price of the TLT, which is the long-term Treasury bond, which has basically been putting in lower lows and lower highs for, well, coming up on 4 years. So tough time for bond investors. And when we just do this simple comparison, if we compare the S&P 500 to the aggregate bond index, since rates bottomed, stocks have relatively been outperforming ever since. And they continued in this past week. So as we've talked about, we prefer stocks over bonds as an asset class. In rising rates, we've highlighted that dividend growth tends to do better than high dividend paying stocks, because people are looking for a rising stream of dividends to offset rising cost of living. And outside of the initial part of the bear market in US stocks into June of last year, you know, dividend growth has been outperforming pretty steadily. In fact, dividend growth stocks bottomed a full 3 months before the stock market bottomed in October of last year. And so this is one of the most important themes we think for private investors. Companies that generate excess cash don't need financing. Doesn't matter what rates do. They have an opportunity to grow their dividend or buy back shares, and that makes them attractive. So since a year now, we've seen a broadening market. From March 15th of 23 through March 15th of 24, the equally weighted S&P was up 20.6%. TSX was up 16.6%. The aggregate bond index up 1%. I'm proud that our equity portfolio is up 29.26%. Our income portfolio, which you might compare to high dividend stocks or the aggregate bond index, up 21%. And our global macro portfolio up 25%. If we look at year to date, we can see that the equally weighted index is up about 4%. The all world index, the MSCI all world index, ex-US, the rest of the world's up a little over 3%. Our new global fund, which is against the MSCI all world index, up just about 7%. So it's working out well the first few months. And equity portfolio is up 10, income's up 8.8, and the macro portfolio is up 7. So all of the portfolios, I think, performing pretty strongly as our themes really have become engaged over the last year. And one of those themes has been commodities. Commodities bottomed in 2020, had an initial strong run up into 22, which is when the Fed and other central banks started to tighten. And we've seen a series of consolidations, one, a move higher, two, but then over the last month and a half, we've started to see commodity prices move higher again, trading above all the long-term moving averages. The technicals are pretty positive. We look at the percent of stocks in the index that are trading above the 200-day moving average. We can use breadth in commodities as well. We take all of the commodities and look at what percent of the commodities are trading above their 200-day moving average. You can see that while they were correcting during the Fed's tightening cycle, the number of stocks above the 200-day moving average was actually rising. We're now sitting at around 60% of commodities trading above their 200-day moving average, or lots of them in uptrends. If we compare commodities to bonds, commodities are outperforming clearly. So we like stocks in general. We like commodities in general. We prefer to stay away from bonds in general, except for where mandates say we have to have them. So inside the commodity group, what's happening? Well, for one, copper over the past 2 weeks had a great surge, higher, breaking out above $4. We think that's significant because that breaks it above this consolidation that's been taking place over the last 2 years. You can see on the big picture, going back to 2011, this was an important consolidation and finally breaking out to the upside. We're seeing that in some of the stocks. I can also say that from an energy perspective, energy over the last 3 months has started to move smartly higher again, despite the fact at the end of February, most fund managers were significantly underweight energy. So you can see a theme. Often the opportunity arrives when other people don't understand that there is an opportunity or they've thrown in the towel. Gold, this is a classic example. One of the most hated assets. But yet from 2011 through 2020, bear market, gets to new highs, now just starting to take off. My guess is that over the course of this year, gold prices probably go higher and probably the producers of gold perform well, but again, a pretty uniformly unliked asset. We're trying to find things that have become under-owned, that are unloved, that are seeing a structural change take place where multiples can expand as investors regain their interest. And we're seeing this across multiple areas of the market that are not well focused on. Bitcoin may be another. We'll see. We're trying to see if it can push through to make a new high. But again, we've seen a series of these over the years, and every time eventually it did, you got a nice sharp run up in price. So lots of inflection points that we're looking at. We don't have to be everywhere. Our job is to try and identify those key themes that are maybe misunderstood, but where we can see clearly something's changing for the better and focus in those areas. We're always looking for new areas of leadership, or frankly, old areas of leadership that are receding, And in the absence of leadership, we're happy to sit on cash. Not right now, we're pretty fully invested. It's quite a tactical approach. You know, without beating a dead horse, we think it's really important to find the right neighborhood. 70% of return comes from getting to the right asset classes and sector themes. And that's what I spend my time on, trying to identify which areas we should be focusing in. And then our fundamental team, and James is one of the key leaders in that group, spend time drilling down through the universe of public securities, trying to find companies that have improving business fundamentals. And we like to say we're looking for good getting better, strong to begin with, but where we can see something fundamentally changing in the business. And where price or the share price is behaving the way that we would expect it to, given what we think we know is happening that's changing for the positive. So positive fundamentals and positive technicals in areas of the market that people care about. We're always looking for areas of expanding breadth where more and more stocks are performing well. And on the other side, we want to be very careful of groups where breadth is narrowing or where one by one stocks are breaking down. Maybe the leaders don't break down first, but the weaklings do. That gives us a clue. So where do we sit now? As of today, our long-term breadth models, or the percent of stocks in uptrends, has been improving in Canada, in the NYSE, and for global equities. The percent of stocks trading above their 50-day moving average have pulled back a little bit globally and for the US. But in general, percent of stocks above the 200-day has been improving. Percent of stocks making new highs versus new lows has been improving. The long-term indicator positive in the short run, as we've talked about over the last 3-4 weeks. Seasonally, there's a little bit of mushiness. The market's gone sideways for the last 15 days. I think these appear to be very resilient. The market is handling news that's coming at it very well. We'll see tomorrow how it reacts to the Fed. So coming into the Fed, and I always care about this, how is the market set up coming into the news? Well, the leading group in the market over the last, let's call it 6 months, has really been financials, quietly underneath the surface. Look at this. These are weekly bars. Green, 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 mild red, green, 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 green. The market's been marching its way higher. It's not homogenous. There's groups that are leading, groups that are doing more poorly. But when we look at the very long picture again, this is a new bull market. So a group that's not well loved in the rest of the world outside of Canada. We've been seeing leadership from the insurance group. This is the KIE insurance ETF. It's made up of life cos. It's made up of property and casualty companies. You can see that relative strength started to rise in May of last year, 2022. So prior to the market low in October of 22. And it's been strengthening ever since. So the whole sector is trading better than 82% of companies in the S&P. Now, our two biggest positions here, we've talked about Fairfax, which suffered a little bear attack when Muddy Waters wrote a short selling research report back in the beginning of January. Didn't take it long to recover from that and continue to march on to new highs, trading better than 91% of stocks in the S&P. Second biggest position we have in the firm, in the insurance group, is Progressive. Again, property and casualty insurance. And these companies have been able to raise their premiums and get better returns on their investment portfolios. In banking, we've preferred the big banks, as we've talked about, versus the regional banks. Of course, the regional banks are the ones that largely have a lot of commercial real estate exposure. The big banks have very little. So JP Morgan is the granddaddy of the bunch. Oh, and I didn't put the right chart in there. I'll have to put it up again next week, but it just continues to march higher. Strongest balance sheet, spending the most on technology, having the easiest time gathering deposits. They've been able to gobble up regional banks that got into difficulty. In Canada, National Bank would be our biggest position, along with Commerce. And National Bank has been the most entrepreneurial of the banks. Share price moving from $84 to $112 effectively since October. And on top of its 4.2% dividend, looks like they can continue to grow their dividend double digits. So again, we're not looking for the highest dividend, we're looking for the one most likely to grow. And National Bank has done a great job growing organically. Industrials, next most important group. So the industrials up almost again 30% since October. Quietly under the surface and not all that well followed. We've talked about how so many of the leading stocks have been industrials over the last number of weeks and months. I looked yesterday of all the companies making new highs. There were 20 companies from the industrial sector making new absolute and relative new highs, including companies like General Dynamics, which we own. We own some Train. But of course, we own Eaton Corp, which has been charging along, trading better than 93%. We're always watching relative strength. You can see share prices move higher sometimes, but in fact, they're actually lagging the market. This relative strength line is important to us because it tells us that we continue to outperform. We watch for that to roll over. And we certainly had, I was going to add another stock today, but I guess there's one more we'll have to add next week. Technology. So this has been absolute leadership in the market since January of 23. After a 36% decline through 2022, it did take us 2 or 3 months to get there. But people like James, pushed us on the change in some of the fundamentals to take a hard look, and thankfully, got us into some excellent positions. Some of them have waned a little bit from a relative strength perspective. You can see relative strength for this is the XLK, which is the large cap technology ETF. It is not making a lot of progress versus the market, but it's remained very nice and strong. I thought James could come on today and talk a little bit about some of the changes. We've taken our weight down a little bit in technology. But not because we didn't do well. We did great in the positions. James, what's changed and what stayed the same?
Yeah, thanks, Dave. It's nice to join. So when you look across the firm, we sit with about a 14% tech weight right now. It's come down about 3% over the last month from 17% before. And really, it's just been some trimming here and there of positions that have broken down. I'll mention two specifically. We sold Palo Alto, the cybersecurity name, after they reported earnings, and they chose to enter a price war, which was a stark shift in strategy. Would have been tough for us to predict that choice by them. So stock sold off sharply, and we were gone on that. We sold Adobe early last week before they reported earnings, and that was definitely the right call.
Kudos for you on that. So James, this is the stock starting to move lower. We rallied into the earnings. You exited in here, and then the following week,
That's right. We didn't like the way it was trading at all, which is a bit of a premonition to weak earnings. And so, they're a great company with a great generative AI product, and they're one of the few companies that can say they're earning generative AI revenue today, which is especially rare in software. But management has been conservative with guidance the last few quarters they've reported. So it was our view they disappoint investor expectations again with their guidance for the rest of the year, and we were right. So you can see how they traded on Friday. So it was a good miss.
No, it's not exactly in this sector, but people think about it. Apple, has been sloppy since kind of the middle of December. I know we made an exit, I think, in the third week of December. What do you think it needs to have there? I mean, lots of people continue to own it outside of the firm. What do you think the big issues are there?
Well, it's a big weight, and we don't compare it to the index. We rarely look like the index, but a lot of people do, and it's a must own in that case. But for us, it'll take a lot for us to get comfortable with it. Not owning any is a sharp underweight to market. And really, there's a lot of uncertainty coming into the U.S. election in November about anybody that has Chinese production. And Apple obviously has a substantial amount of Chinese production. I think over the course of the last few years, the company's demonstrated an inability to innovate. The VR headset, I don't think, is very compelling. It's not selling well. They axed the car. Smartphone, so iPhone's not been as strong as would have been expected. That product's been pretty uncompelling as well. So they've just struggled to get out of their own way. In AI especially, this is something that they're behind the ball on. And we saw an announcement yesterday that Apple might be offering the Google AI product on iPhone, and they'll probably have to do a partnership like that. It's really hard to square Apple's focus on privacy with building a generative AI product because you need user data to do that, and Apple lacks the user data. There are other issues as well. A lot of the growth in the company has come from their services segment, which is challenged from a regulatory perspective in the US. We've seen them have to open up App Store to third-party payments, which circumvents Apple's 30% take rate off the top on all in-app transactions. So it's just been tough going. It's a great company and the products are fantastic. We all have an iPhone, so it'll probably work eventually, but it's also expensive for the way it's lacking growth right now.
Yeah, yeah.
So we've just avoided it, and it's been a good call.
Okay, so now on the other hand, you've managed to keep us here in NVIDIA with a really great position. We entered at $190. It's 896 just before the close today. There was a pretty big event yesterday, and one of the concerns that some people have expressed is whether NVIDIA can maintain its dominant position in processors for GPUs for AI. To tell us a little bit about that event and how significant it was.
Yeah, it was significant. So it was the NVIDIA Annual Developers Conference. They have it every year around this time. You can see on the chart, that's the founder and CEO, Jensen Huang, holding up the new chip they announced. So it's called Blackwell. So just to go through some of the specs, for these big consequential product releases, NVIDIA generally hints at what's to come, will speak to analysts who've generally spoken to suppliers, and it's rare to get a big surprise. That's why the stock's not up on a stick today, but the product is really amazing. So Blackwell architecture, it was expected this is two GPU chips connected by a 10 terabyte per second chip-to-chip link. It'll do AI training 4 times faster than the previous generation. And it'll do AI inference 30 times faster than the previous generation. So a huge leap. Not to get too into the weeds, but it's built on the same process technology as the previous generation. So it hints they have a bit more gas left in the tank for generations to come, which is nice. It's been a while since we talked about it on the call, but just to go through quickly on compute power for AI, there are two types, training and inference. Training is more computationally intensive and it's done in AI development. Inference is less computationally intensive and it's done in actually the running of the AI. There'd been a concern by investors that buyers would trade down to cheaper options when running inference workloads. This product release helps alleviate that fear because even though the chip costs more, you can plow way more field, so 30 times more than the previous generation on the inference side, which makes it a lot more cost effective when looking at competitor products, specifically AMD.
Is
So
anyone close on this?
no, AMD was getting close to the previous generation of NVIDIA chips, but nowhere near close on this next generation.
So as long as they can keep doing this, ultimately it may be that they're building a technology platform that everybody else builds on top of. Is that right?
That's right. They moved early with the acquisition of Mellanox to own data center acceleration. This was years ago. This was 2017 or 18. They did that deal when people first realized that GPU added to data center would really increase computational ability. So it's just been a winner. The company's proven that they have the ability to go through multiple acts, as we've talked about before. And this product, for a chip, it'll be probably $35,000 which is 40% pricing uplift from the previous gen. And NVIDIA will be making north of 85% margin on this product. So it really is, it's eye-popping.
Well, I just look at the technical picture and, the secondary breakout came when it traded above sort of $505, which had been its ceiling all through 2023, and we got into 24 and look at the run once it broke out. So congratulations on that, James, and thanks so much for all your work on that.
Thank you.
You know, to go from one place to another, you couldn't look at anything more different, but there's the materials chart, XLB ETF. It also has run into ceiling a number of times over the last 18 months, but you can see now, really since the beginning of 2024, a sharp move higher. Now, materials is a broad group. Of course, it includes copper, and we saw the copper ETF break out of consolidation this past 2 weeks. This includes, you know, companies like Tech B, which is a big holding for us. We talked about what it might mean when it eventually got out of that. Consolidation has been going all the way back to 2011. We think that this could be a very significant leading stock over the next year. We talked about Capstone Resources, Freeport McMoran, the same thing, has just gotten up and above its resistance. So that's quite interesting. That's on top of companies that we own in the aggregate space. We've talked a little bit about infrastructure building and construction in the US, especially manufacturing, construction. Vulcan Materials makes aggregates used in paving and construction. It tends to be selling into sort of local markets, trading better than 90% of companies in the S&P. And a new ad this week is Owens Corning. You can see just starting to break out. Owens Corning, you know, we know the name Corning for lots of things, including fiber optics years ago, different company. But Owens Corning is industrial products. It's home building materials, roofing tiles, pink insulation. And we know that the housing construction market in the US is quite strong, and certainly the pricing is strong there as well. So companies you wouldn't, you know, maybe first think of as being leading stocks, and certainly this appears to be one of them. So energy has moved up sharply over the last 3 weeks. One of the biggest areas of gains in the market. One of the things we watch for is when a high percentage of stocks all take off at the same time. It's important. Over the last 2 weeks, it's been 3 stocks up for every 1 stock down. Over the period, we can call that a breadth thrust, which probably means it's the beginning of a new move higher. And we know that one of the leaders that we've talked a lot about is CNQ, and it's really moving up and away. So, you know, the growing dividend here, very, very attractive. And we know what happened the last time it broke out of a bear market. It had a very long run. So lots of things going on in this market, and certainly tech is one of them. But there's some groups that are not as well owned, that are not all that expensive, that are companies that generate a lot of cash, that are showing a willingness to raise their dividends and buy back shares. You know, CNQ's announced they'll use 100% of free cash flow to raise dividends and buy back shares. Other companies in the area, we have a very big position in Imperial Oil. We like its 2.7% dividend that grew 22% this year. We have a position in Athabasca, which does not have a dividend currently, but we think will. Again, very long reserve life and great opportunity here. And it's interesting when we look at what's happening in the market. You know, in the last week, energy and materials, the 2 strongest groups. And the low end, real estate, utilities, a little bit weaker. When we look at groups outside of our sort of core leadership groups, healthcare, you can see the prices have been moving higher, but relative strength actually making a new low versus the market. Consumer discretionary not making any relative gains. Consumer staples not making any relative gains. Real estate not making relative gains. So it's a market where risk on is behaving better than risk off. Those groups we just looked at, more defensive, not performing that well. Economically sensitive groups performing well. So look, I'm not going to say we know better. We don't. We follow the message of the market. We aren't going to fight the tape. The market generally gets it right. There's a lot of smart people out there allocating capital, and they aren't trying to make foolish decisions. But I think it's interesting. When we look at the firm positioning, we have a very significant overweight in financials. It's gotten a little stronger. Our technology weight has slowly been coming down. It's about half the S&P weight, as some of the leading stocks have backed up a little bit. We've continued to have a very strong overweight position in industrials and a strong overweight position in materials. We have an overweight in energy. And then really the rest of the group sort of underweight healthcare, underweight staples, underweight discretionary, underweight telecom, underweight real estate, and underweight utilities. A very small weight in bonds. And that's frankly because we'd rather have dividend growers than fixed income. So that's how we're positioned. This is how the street's positioned. As of March 24 last week from Bank of America, biggest overweight position in the market, bonds up 1% over the course of the last year. US stocks are overweighted, but led by telecoms and utilities. On the underweight, people are underweight energy. They're underweight Europe and the UK. They're underweight materials. They're underweight insurance. They're underweight banks. They're underweight commodities. All these things that are performing better than the market. So we think it's a really interesting time. A really interesting time to recognize that there's been a structural shift in the market that people have not positioned for yet. In the past week, the groups that made the biggest gains in relative performance, copper, property and casualty, France, Peru, commodities, silver miners, insurance, these are kind of the groups we're focusing in. When we look outside the US at the MSCI All World Index ex-US, this may be why it's doing a little better. It's got a very large financials weight, a very large industrials weight, a very large materials weight, a larger than S&P energy weight. It just happens to have the right sectors, so we think that makes global stocks a good diversifier against the very significant positions we have in dividend growth in North American equities. Things we're watching to see if anything's changing. We're always watching credit risk. The excess return bond investors are demanding to take a corporate bond versus a government bond. And now, for the last 2 years, the excess return they're demanding is falling, meaning they don't perceive lots of credit risk. We're watching volatility, which is remaining in a very low range, a range actually more associated with a running bull market. So breadth indicators are positive. We're getting through a little bit of weaker seasonality. The market's been hanging in very, very nicely. It'll be interesting to see how the market handles the Fed's comments that come over the next couple of days. But in general, we think the key themes continue to truck along and the portfolios are benefiting. We think that there's some room for this to carry on. Maybe 2-3 years before the next significant correction. We can get a 5%er at any point in time, but we can't even point to short-term indicators that would highlight that risk now. If things get worse, we'll get more defensive. And as usual, we'll continue to do these webcasts every week. Hopefully they're useful. So with that, let me just see if there's any questions. One of the questions I had off the hop before the webcast today, excuse me, was how aggressively positioned is Barometer for aggressive Fed rate cuts? Well, the things that we think would be most helped by aggressive Fed rate cuts would be unprofitable technology companies because they may need financing, real estate companies because real estate investing tends to need capital, certainly commercial real estate, and we own virtually none of those things. The other thing you would want to own if you thought that there was going to be aggressive Fed cutting is bonds, because of course it's a direct correlation. Rates go down, bond prices go up. We own very few bonds. It's great to see inflation moderating, but we think that it's relatively sticky. And we think we want to own companies that have pricing power, companies that generate lots of cash, that gives them the financial flexibility to deal with whatever environment comes. I've always said, we want to own companies that are good getting better, companies that are doing well already, that aren't dependent on something changing for the better. And right now, all the companies we own are benefiting in the current environment, even with higher rates. So no, we're not making bets on significantly lower rates. Next question is, would we wait for pullbacks to enter Europe? And let's just take a look at that quickly. So first of all, here's a 5-year chart, 1-year chart. This is the Eurozone financials. Sorry, Eurozone 50, working its way higher. First thing I'd say is Bread's model is positive. If we pull up FEZ, see we just made a new high. It could certainly pull back to kind of like 49.50 from where it's trading now at about just about 52. So it's a 4% pullback. I wouldn't be banking on it, but it certainly could pull back to the 50-day at any time. What I would say is the breadth models are positive for Europe and both short and long-term indicators. So maybe, if you were entering a new position, you start with half now and add some if it pulls back a bit. The risk is that it kind of moves away on you. We're certainly watching the US dollar to see if it can back off. If it backs off, probably that's a support again for global stocks. So if you want to get cute, you probably could. I'm not sure that you need to wait on that one. Let's just take a look at what other questions we got here. Given copper seems to be overbought, would it be prudent to take some profits or let it run? It really depends on your time frame. I mean, I look at the COPX. Again, when it's broken out of a wedge like this, it can always pull back and retest the top of the wedge. So that's what, $39. We're trading at 40.5. I don't see it pulling back, to the 200-day moving average. I'd be really surprised now that it's up and out of that wedge. When I look at some of the individual names, they've kind of corrected a little bit. This is 4N mining, pulled back a little bit today. Maybe it could pull back to the 50-day. I don't expect it to. Capstone, copper, it's pulled back a little bit over the last couple of days. It could pull back into the 50, I suppose. But I don't really expect it now that it's broken out of this longer term consolidation. I'd be a buyer here. Freeport and Tech B, I feel the same way. It's my picture is, what's it going to look like a year from now? And I think you have to, when you buy something like this, expect it could pull back 5 or 7% without too much difficulty. But I think that's not the most likely outcome. I think it's more likely to go higher. It's just starting. The long-term picture on this, I think, is really quite attractive because you're just starting a new bull move. Next question. Are we in the pipelines given the increase in strength and energy? We don't have a big exposure. We do own AMLP, which is an ETF that wraps up MLPs or master limited partnerships in the US. The reason that this one is interesting is that it takes away the need for doing specialized tax reporting. We don't own a lot of the pipes in Canada. We've been more in the producers. One other question here. Oh, Cameco, NextGen, and the uranium sector. I think it looks okay. This is Cameco. We've come down through the 8 and the 21-day. We're above a rising 50-day. If I look at the point figure chart, it looks just fine. If I look at NXE, to disclose, I do own both NextGen and Cameco in my pro account. I think they look good, that they're consolidating this initial move. This is trading, above the short-term moving averages. I think that they're okay. I wouldn't want to see NXE break kind of like $9. So that's 10% lower than where it is. You got to recognize this is a more high octane position. Cameco, I don't think I'd want to see it trading below the 200 here. But I think that it's probably not a terrible entry point. URA is probably the same. We own URA in our macro portfolio. And again, I just always have to pull the lens back, right? This is probably just getting going. So we'll see. I think that is most of the questions. And I think that we're out of time. I want to thank everybody for joining us. I want to thank James for jumping on today. I really appreciate that. Oh, quick one on the IWM small caps. Look, I think that in the near term, it looks a little bit like, Canada had lots of chop over the course of the last year. And we've just gone up and we're back sort of retesting the breakout here. I think it looks okay. IJJ, I think looks better, which is mid-cap value. On a relative strength, from a relative strength perspective, they probably need a little bit more work. They're very cheap relative to large caps, but there's a ton of banks, regional banks, in the mid cap index, which is one of the things that's probably holding it back. And if we look at KBE, the large banks ETF, and compare that to KRE, it's a lot weaker. So we've stayed sort of with the large banks, and we do have a little bit more large cap exposure. We own if we've got a tilt, we got a little bit of a tilt to value, which is acting a little bit better. Anyway, I want to thank everybody for tuning in. We'll be back next Tuesday. If you have questions that we didn't answer today, please feel free to give us a call or send us an email. We're obviously in the business of growing the company, and we're always interested in meeting new clients. And for those that are clients, thank you so much for being patient with us and having the faith in us to take care of your valuable assets. So everybody have a great week, and we'll see you again next week.